and welcome back to my YouTube channel. In this video I want to talk to you guys about the 6 things you must do before you apply for a mortgage. So yeah, there's no real introduction to this as such. Basically, I'm just going to cover off the 6 things that I personally think you must do before applying for a mortgage. So without further ado, let's just jump right into the video. So the first thing I think you must do before even considering applying for a mortgage is to have your deposit saved up. When applying for a mortgage, you'll most likely have a house in mind that you're wanting to buy, so you'll know the rough value of it. In order to speed up the process of actually getting a mortgage, you should definitely have the sufficient deposit saved up. Now, right now, obviously, with lenders making it more and more difficult to obtain a mortgage, you should be looking at having at least 15% saved up. Now, what a lot of people fail to account for as well is all the extra costs that are involved in actually buying a house and getting a mortgage. Now, a lot of lenders do have an arrangement fee that they charge. A lot of the times they do have products where the arrangement fee is actually nil, and obviously that's something that you can speak to your mortgage advisor about, as they'll be able to compare the different products and provide you with the most suitable one. The other costs involve your legal fees, your valuation fees. Now, once again, with the valuation fee, a lot of lenders now do provide a free basic valuation. However, if you are buying a house, especially if it's your first house, you want to know if there's anything wrong with it. So I'd say pay that little bit extra and get a home buyer's report, which just provides you with a bit more detail as to what's been done to the house and any recommendations for initial repairs. So I'd say on top of your 15% deposit, I would consider having another £2,000 at least for all the other costs. Now, the second thing you should definitely consider is paying off as much of your debt as possible. So if you are someone who has credit cards or who has store cards, anything like that, make sure you pay off as much as you can of those, just because the lenders do look at any outstanding balances when it comes to checking your affordability. Now, with credit cards, for example, they normally take 5% as your monthly repayment of any outstanding balance. So say you've got £1,000 outstanding on your credit card, they will account for £50 a month being put onto that credit card. So that's £50 less on your affordability assessment. Now, with other loans such as personal loans, car loans, contract hire, anything like that, the lender will actually look at the final outstanding figure and they will actually reduce the amount you can borrow by that amount. So if your current agreement or your current loan is coming to an end and you are thinking, well, I'm going to have to get a new car, I would hold off making any big expenditures, especially in this kind of 3 to 6 months leading up to your mortgage application. Don't know what happened to my voice then. My third must do is to check your credit score. Now, let me tell you a little story that actually personally happened to me. So when I was applying for my mortgage, everything was going fine. I managed to get everything agreed in principle. Everything was as it should be. I had the house in mind that I wanted to buy, put an offer in on the house. Everything was going really smoothly up until the lender actually carried out a credit report on me. Now, I get this phone call saying, is there anything you want to tell us? And I thought, well, not that I'm aware of. Anyways, it turned out that I actually had a CCJ on my credit file, which is a county court judgment. It was for an unpaid parking ticket, which I actually personally disputed because I had paid for the parking. I personally thought everything was sorted once I disputed it, but it turned out they actually put in a CCJ claim against me, and that then sat on my credit file, which I wasn't aware of. And yeah, it nearly cost me my house. It nearly cost me getting a mortgage on the property that I really wanted. Now, I managed to get that sorted in the end, and I ended up buying my house and everything was fine. However, in order to avoid that, it's a heartbreaking feeling when they basically tell you that you might not be able to buy your dream house. So in order to avoid that, I would just check your credit report before you even think about applying for a mortgage. As I say, just to ensure there's no nasty surprises on there and you are aware of everything that's on there. In order to get one, you can either go go to Equifax or Experian. Now, I personally carried mine out recently with Experian. It was free, however, it did take quite a while because they send you like a code in the post that you then have to input onto the system, and that's how you get your credit report. So make sure you allow plenty of time to get your credit report, but ultimately it's really, really useful. And I've put some links down below. They're not sponsored, they're not affiliate links or anything like that, but I've put them down below just so you can have a look at them, and if you are at a stage where you want to get your credit report, you can use those. Just one last thing on that, your credit report is different to your credit score. Now, your credit report will have all the details, such as any county court judgments, any loans that you've got in your name, any credit cards you've got in your own name, stuff like that. So it basically just verifies all of your financial information, whereas a credit score just simply gives you an overview of where you are financially, which, to be honest, isn't what the lender particularly looks at on a mortgage side, as they want to know the detail. Number 4 is to obtain quotes from 3 different local solicitors. Now, why 3? Why local? What's the point? What I found is a lot of solicitors in the area will charge different amounts for the same work, because ultimately it is going to be the same work that they carry out for you. Now, when you get your 3 quotes, obviously you'll probably have a range of different ones. So you'll probably have one that's the lowest and you'll probably have one that's the highest. I personally wouldn't always go with the lowest quote, and I'll tell you why. I would always go off recommendations from other people who have also bought a house, as that then allows you to actually figure out how long it's likely to take for you to complete on a purchase. Most solicitors will tell you 6 weeks, but in reality it's rarely 6 weeks unless you've got a really, really good solicitor. That's why speaking to other people who have already been through the process with a certain firm, they'll be able to tell you how long it took on their purchase. Obviously there are various aspects involved in this, and if it's a more complicated one or if there's a chain, it obviously will naturally take longer. However, if it's a straightforward purchase like I had on this house, for example, it should ideally take in the region of 6 weeks. Now, the reason I say local firms is because ultimately I find that local solicitors are the ones that do the best job, just because they highly rely on recommendations, they highly rely on the word of mouth and the referrals from friends and family. That's how they get most of the business, and ultimately they know the area as well. So if anything comes back in your searches, they'll be able to tell you what action you should take, what you should consider, and they can also liaise directly with your mortgage advisor and let them know what the issues are, and the mortgage advisor can then also give you their opinion on how you should proceed. My must-do number 5 is to get all the relevant paperwork ready in one place. So anything that your mortgage advisor or the lender will ask for, I think you should have, say, in one folder, just so when they ask for that information, you've got it ready to hand, which will in effect speed up the process. So what do I mean by paperwork? Now, every single lender will ask to verify your identity, which is a pretty standard procedure. So all you'll require for that is your passport and a driving licence to verify your address. Now, if you haven't got a driving licence, any utility bill in your name, anything like that will also do. However, if you haven't got anything like that, do speak to your mortgage advisor, as they'll be able to tell you what else will be accepted by that particular lender. You'll also require at least 3 months bank statements, basically for the affordability assessment. Now, some lenders will ask for 6, so also be prepared to provide 6 months bank statements on your current account. And then in order to confirm your income, they will ask you for your last 3 months pay slips and your last P60. If you're self-employed, they normally will ask for at least 2 years accounts for the business, sometimes 3. And if you haven't got accounts for the business, say you're a sole trader, they will require your tax returns for, once again, at least the last 2 years or even 3. The best thing to provide your mortgage advisor with is the SA302 tax computation, as that has all the income broken down, and it just once again speeds up the whole process. So just make sure you've got all those things together for easy access, so you're able to send that on as soon as you get asked for that information. And the last thing I'd say you must do do before applying for a mortgage, and you will have heard me refer back to this one particular phrase a lot throughout the video, is to find a mortgage advisor to help you with your journey. Now, why do I think you should get a mortgage advisor involved? And that's because they're able to not only explain the process to you from start to finish. If you're nervous about it, they'll be able to literally, well, not literally because COVID, hold your hand through the process to make sure you fully understand the commitment that you're getting yourself into and what that means going forward. They'll also be able to tell you what you can and can't afford based obviously on your income, on your expenditure. And you might have a house in mind for £200,000, but after going through everything, you may only be able to borrow 130. So, that's why it's so important to get a mortgage advisor involved, because they'll be able to tell you everything before you have your heart set on a certain property. Or if you do have your heart set on a certain property, they'll most likely be able to actually tell you the steps that you should take in order to be able to afford that and how long that could roughly take. Another reason why getting a mortgage advisor involved is they'll be able to search the whole of market for you to ensure that you get the best deal possible. As if you go directly to a lender, 9 times out of 10 you're probably not getting the best deal that's out there, because they're only giving you their own products. So it's always best to compare rather than just going with the first best thing. And also, if you come across any issues, such as me with my unknown CCJ, they'll be able to help you in sorting that out and give you a bit of advice on how to proceed with your case so that you don't lose out on your dream property. So guys, that is it for today's video. I hope you found it useful and it gave you guidance on what you should do or must do before applying for a mortgage. If you like this video, please give it a like and also subscribe to my channel down below, as it really helps my channel to grow. Now, in the next video, I'm actually going to talk about equity release and what it means, because what I found recently is a lot of people don't actually understand equity release and they do get it confused with something completely different. So stay tuned in and I'll see you guys later. Bye!